5. When FCFE gives you equity value directly. What FCFE measures? FCFF measures the cash that belongs to both shareholders and creditors combined. FCFE takes a different starting point and asks a more specific question. After the company has paid its taxes, reinvested in the business, and settled all obligations to creditors, how much cash remains for shareholders alone? That remaining cash is free cash flow to equity, or FCFE. When you discount future FCFE at the cost of equity, the result is equity value directly, without any further bridge calculation. This is the key distinction between the two measures. Shareholders versus creditors. What each receives. Creditors have a fixed contractual claim on the business. They receive interest payments on schedule and their principal back at maturity, regardless of how well the business performs. Shareholders receive whatever is left after those creditor claims are satisfied. FCFF represents the total cash pool before it is split between shareholders and creditors. FCFE represents only the shareholders' share of that pool after interest has been paid and after the net effect of any debt raised or repaid has been accounted for. A company with significant debt will show a much larger gap between FCFF and FCFE because the creditor's share is larger. A company with almost no debt will show figures that are nearly identical because very little cash flows out to creditors before reaching shareholders. Part 2. Calculating FCFE. FCFE starts from FCFF and makes two adjustments. Subtracting after-tax interest removes the creditor's portion of the cash flow because that cash has already left the business to service debt. Adding net borrowing reflects the fact that new debt raised is cash available to shareholders, while net debt repaid is cash that leaves on their behalf. For NVIDIA in FY 2026, FCFF was approximately $91,551 million. After-tax interest expense was approximately $220 million, which is very small relative to NVIDIA's size because the company carries minimal debt. Net borrowing was zero. FCFE therefore came to approximately $91,331 million, almost identical to FCFF. For a heavily leveraged company, this gap would be far larger. Why FCFF is the standard in practice? FCFF is independent of capital structure. Whether a company finances itself with 10% debt or 50% debt, the FCFF figure reflects only the operating business, free of financing noise. This makes projections cleaner and cross-company comparisons more reliable. FCFE is preferred in specific situations where the business model is inseparable from its financing, most commonly banks and insurance companies, where deposits and borrowings are the raw material of the business rather than external leverage. For all other companies, and throughout this course, free cash flow refers to FCFF.